Good morning. Welcome back to the Junius Maltby channel. Today we're going to take a look at several things, precious metals going into 2018. Might have to make a second video just on that alone because there's two papers out today that I want to cover. One of them more focused on platinum. So we'll look at that. I also want to take a more focused look on the foundations and the base for gold. You know, we've seen some comments lately. I was in a couple of different discussions yesterday where people were trying to predict where gold was going to end up, what we might see. And I see a lot of people saying things like $1,000 gold, under $1,000 gold. I even see people saying $700 gold. And we hear that quite frequently. I've addressed it in the past, and I've used my reasons on why I don't see gold going to that level. And just to summarize it real quick, just my personal opinion on it, and I could go into more detail, but I really see 1100 or 1140 more specifically as that base, that foundation for gold. My reason for that, the number of extremely large tonnage purchases. Just one example alone would be India at 220 tons purchasing gold at I believe 1140. I think that was their buy-in price at 220 tons of physical delivered gold. Don't want to spend too much time on that, but I just don't see gold going below the levels that a lot of those central banks locked in at. I don't think they made a bad decision when they purchased gold. I think they put some research, some numbers together, and then they realized that that was a good buy-in price, and that's why they locked in. So it's neither here nor there. Again, we're talking about fiat US dollars and the valuation of gold denominated in dollars. And as we all know, the dollar is just a disease. So let's take a look at the headlines today and get right into some of the articles that we're going to cover. As you saw scrolling by, all in green metals, gold has regained some lost ground as the dollar struggles. I'll show you a dollar chart in just a moment. Gold price is building a strong foundation for a sharp rebound leap ahead. And here's a snapshot from this morning. Silver, 10 cents above the 17 mark, up 0.83%. Gold up 0.67%, up $8.60 at $12.90 and 30 cents. Copper also up, platinum up, palladium up. So all metals in the green. Looks like palladium is back at $1,000. Here's a quick look at the gold COMEX chart. There you can see up 860, 1290, and 30. It's trying to retake that 1300 mark. We'll see if it can do it today. And a lot of this is due to the dollar. Here's a 5-day chart on the dollar. There it is, falling off a cliff there. This is the 1-day chart, dipping well down to the 93 zone. There is some talk of uncertainty at the Fed. Looks like Yellen will soon be replaced. And there were some Fed minutes out today that are driving the dollar in this particular direction. Another headline from this morning, gold gets a boost from weaker dollar ahead of Fed minutes. Gold rose Wednesday, getting some help from a weaker dollar ahead of the latest peek into Federal Reserve thinking on upcoming interest rate policy. December gold up 0.69%, gained $6.10 or 0.5% to $12.8770 an ounce. That builds on a Tuesday gain after the metal suffered a loss of 1.6% on Monday. The exchange-traded SPDR Gold Trust, GLD, up 0.85%, edged up by 0.6%. We're starting to see the big banks come out with their predictions for 2018, and it's always good to pay attention to what they think precious metals are going to do. Last year it was impressive because they predicted one thing and then immediately had to revise it as circumstances determined that gold would take a different direction from what some of the banks predicted. But here we see gold price forecasts from UBS for year end and into 2018. UBS says, quote, gold in a reasonably healthy position for a rebound above $1,300 towards the year end through to early 2018. I will continue to reiterate that I do not believe you will have an opportunity to purchase gold at the 1,000 or even below 1,000 again in your lifetime. I just do not believe it's going to happen. So if you're waiting to lock in to do a gold purchase at 1,000 or below 1,000, you might be waiting until you're a skeleton. They cite a few macro factors have been supportive of late. The pullback in the dollar, a pause in the rise in U.S. nominal and real rates, particularly on the long end, consolidation in equities, and political and fiscal uncertainty in the U.S. Latest political headlines out of Europe are probably helping at the margins, although currency moves could complicate the impact. The gold market's correction and subsequent consolidation has generally been orderly. Latest CFTC data shows that gold net long positions have been tentatively rebuilding over the past couple of weeks. Although gold shorts increased for the first time in 4 weeks as of November 14th, volumes were very modest. A combination of resilient longs and hesitant shorts has helped gold form a decent base and enabled prices to climb above some support levels, improving the overall technical picture. We think gold's resilience is in part due to lingering uncertainty. Although macro risks in general are perceived to be lower, there is an acknowledgement that known unknowns and unknown unknowns continue to lurk. Those are very interesting terms. Additionally, some seasonal demand is likely also keep gold supported. Market participants have also indicated a preference to hold off until the FOMC December meeting is out of the way. Commodities facing another tough year in 2018, JP Morgan says. So here's some of the input from JP Morgan. We'll see what they predict for the coming year. Let's just skip right ahead to what we actually want to know, and that's what metals are going to do. JP Morgan recommends going long on aluminum, copper, and nickel. Supply will increase next year, leading to lower prices. Copper will average $5,700 a metric ton in the fourth quarter of 2018, compared with a current price of $6,900. Okay, no one's going to be buying metric tons of copper, but we've got precious metals will be stable through mid-year and then move higher because of worries about a slowdown in economic growth. Gold will average $1,350 an ounce in the fourth quarter. TD Securities 2018 Commodity Outlook. Rates, foreign exchange, and commodities strategy. This is November 20, 2017 from TD Securities. We'll look at what they predict metals are doing. This is a pretty big document, and I might go into it in more detail in another video. There's a chart, 2018 price outlook for key commodities. You can see the commodities listed on the left: gold, silver, platinum, palladium, copper, zinc, crude and Brent crude, and all that oil stuff, but we don't really care about that. I don't buy barrels of oil. Up on top, we'll start with gold. Spot price $12.86, fourth quarter 2017 $12.80, and then we've got 2018. There you can see it. They look at it. Look at that. It's $1,300, $1,300, $1,325. So it looks like it's got a little uptick there. They're looking at gold hanging in around that $1,325 range. On the far right, you can see 2018 at $1,313 and 2019 at $1,350. That's their predictions there. We'll see how accurate they get with that. A lot of you are going to be very interested in silver, so let's see. They've got spot price at $17.15 right now. 2017 fourth quarter, $17.25. And then looking at 2018, they're pretty bullish on silver, looking at $18.50, $18.50, $19.25, $19.25. And then they've got $18.88 there for 2018 prediction, and then $19.88 in 2019. So that's the predictions coming out of there. TD Securities. Platinum hanging around $937, $950, and then going into 2018, we got $1,000, $1,050. So they really see platinum punching up above that 1,000 mark again, and then even hitting $1175 in 2019. Palladium $997 currently, $975 fourth quarter, and then again above 1,000 for 2018, hanging in there around $1,050 to close it out. Looks like about the same prices going into 2019 as well for palladium. And you see here in the list of top commodity trades from TD Securities, if you look over there on the right side on the bottom, you'll see long silver entry 1706, target $20 per ounce, and this stop at $15.15 an ounce. Again, that's TD Securities top commodity trades going into 2018. We'll read the middle paragraph to see what they have to say about metals in 2018. And I'll quote it for here. It's a gentle Fed tightening cycle at a time when the European Central Bank and the People's Bank of China and other central banks are set to start removing monetary accommodation should sap some strength from the US dollar and help the precious metals complex into 2018. The still low global real rates, along with investor desire to hedge in the face of fully valued equity markets, should also buoy gold and help the broader commodity complex. Geopolitical risk highest in 4 decades. Gold demand in Germany and globally to remain robust. Geopolitical risk highest in 4 decades should push gold higher. This is from Citibank. Elections, political and macroeconomic crisis, and war lead to gold investment. Political uncertainty in Germany means gold likely to remain in good demand as a safe haven, says Commerzbank. There has rarely been such political uncertainty in Germany at any time in the country's post-war history, Commerzbank. Reduce counterparty risk. Own safe haven allocated and segregated gold. The geopolitical case for gold investment has been emboldened due to heightened and ongoing geopolitical risk, according to Citi analysts. In every continent, there appears to be major political upset and geopolitical risk against a background of growing economic uncertainty and turmoil. Just this week, we have seen the U.S. declare North Korea's leader a sponsor of terrorism, Angela Merkel seemingly lose her political dominance in Germany, and the EU and the Gulf countries ramp up fear-mongering regarding Iran. What does this mean for gold? Quite simply, its role as a safe haven is now at its strongest point in 4 decades, according to Citigroup. Commerzbank concurs, and this week their analysis concluded that the political uncertainty in Germany means, quote, gold is likely to remain in good demand as a safe haven, unquote. We have seen this in recent World Gold Council figures. Demand for physical gold bars and coins climbed by 17% in the last quarter. This, says Citi, is the new normal. Quote, event-driven bids for gold seem to be occurring more frequently and may be the new normal. In short, even as the rates and Forex channel dominate the outlook for gold pricing, the yellow metal is increasingly being used by investors as a policy and tail risk hedge, unquote. Gold will prove a safe haven from currency storms, is the conclusion of a wide-ranging analysis of the world monetary system by Official Monetary and Financial Institutions Forum, the OMFIF, the global monetary think tank. The OMFIF report entitled Gold, the Renminbi, and the Multi-Currency Reserve System warns of twin shocks to the dollar and the euro and of a coming dollar shock, unquote, and points out how gold would be a safe haven in a dollar crisis. And just so you guys know, I do have a video up on that OMFIF report that I put out when it first broke back in 2013. Many studies have shown that precious metals are one of the few asset classes with a positive correlation coefficient with inflation. According to asset allocation experts, Ubatson Associates, precious metals are the most positively correlated asset class to inflation. From a strategic point of view, Ubatson determined that portfolios could reduce risks and improve returns with a 7 to 15% allocation to precious metals bullion. Gold is a good hedge against black swan events and against tail risk. According to a study by Mercer, the so-called conditional value at risk can also be reduced drastically by adding just 5% of gold to a portfolio. This risk parameter, also called expected shortfall or expected tail loss, defines the deviation in case of an extreme event. Gold investment is the old normal. Geopolitical risk is the new normal. For some reason, as I just read that, I had this voice like echoing in my head of some nerd crying out, Bitcoin's the new gold! Bitcoin's the new gold! Bitcoin's the new gold! No, Bitcoin is not the new gold. All right, got that out of the way. $5,000 gold is necessary to reestablish a gold standard. Here's why. Understanding the old gold standard basics. The 18th century gold standard system that so many people view as a free market alternative to central banks determining credit conditions, money supply, etc., was not really a free market. The system was dependent on the central bank, in this case, the Bank of England, and later the U.S. government, offering to buy all gold tendered to it at a price established by the government. Yes, remember that, $20.67, guys. Moreover, that price had to be far above any foreseeable market clearing price. If it was less than any foreseeable market clearing price, the banking system could not accumulate the gold stocks necessary for the system to work. If the price was too low, private individuals would see it as a one-way bet to accumulate gold stocks, much as they did in the 1960s. The effect of the old gold standard price on the Great Depression. Many economists believe that the supply of gold at the price of $21 per ounce was too low, and that this, together with the French and the U.S. holding too large a share of the gold stocks, was the fundamental driving force behind the 1929-33 worldwide depression. Yes, Bernanke blamed the depression on the central banks, but they were just following the rules the gold system imposed on them. The depression ended in each advanced countries soon after each left the gold standard. Moreover, Roosevelt did much to end the depression when he arbitrarily raised the price of gold to $35 per ounce, increasing the world supply of gold by 2/3. In the 1960s, the problems of an inadequate supply of gold reemerged, and Nixon solved the problem by having the price of gold free to be set by the market. In 1969, there were no significant central bank purchases or sales of gold, so the 1969 price of around $39 probably was a good market clearing price that balanced the supply of gold and the non-monetary demand for gold. What the real price of gold should be these days. Of course, in a free market, there is no reason for the price to remain stable. And in the early 1970s, I conducted a major study of the supply and non-monetary demand for gold, industrial, jewelry, and hoarding, and concluded that, given the price elasticities of demand and supply, to balance the supply and non-monetary demand for gold, the real price of gold would have to rise at a 3% to 5% annual rate. The real price of gold rising at a 3% annual rate since 1969 would have generated a current price of some $900. And if the trend growth rate had been 5%, the current price would be about $2,225 as compared to the current market price of marginally less than $1,400. Conclusion. Given the trends outlined above, I would conclude that to re-establish a new gold exchange standard would probably require a gold price of about $5,000. And that begs the question, what would re-establishing a $5,000 gold standard mean for inflation? I've also seen articles and studies by similar individuals that have stated it was more accurate around 9,000 or even 10,000 today. It's difficult to actually know for certain. However, when you look at all the information, when I look at the big banks, their prognostications and predictions, when you look at inflation, what's going on in the world, that is where I base my firm grasp and foundation platform that gold is not going to hit $1,000 or $1,100. So for those, again, if you're waiting for that to happen, you're going to wait for a very, very long time, and it most likely will never happen. And just to stir the pot a little bit, we'll close out today's discussions with this little piece here, article I pulled up, titled "Bitcoin is a bubble that is bound to burst. Analysts warn." I know what a lot of you are screaming. They've been calling it a bubble since forever. They've been calling it a bubble forever. Okay then. Well, you don't know it's a bubble for sure until it finally does pop, right? So let's see what they have to say. As a heated debate rages over whether Bitcoin is real money or not, the cryptocurrency has defied the naysayers to surge above $8,300 this week. Yet Bitcoin's very effervescence is undermining its credibility with investors who are leery of assets that gain 750% in less than a year. The folks at Bespoke Investment Group are among those who are warning that Bitcoin mania will come to a bad end, much like the dot-com bust that came to define the follies of a buy first, ask questions later investment strategy. You're now seeing classic herd mentality that has pushed the entire space into a bubble that is bound to burst at some point, said the analysts at Bespoke in a report. A very valid point there. We are seeing people, I actually saw an article yesterday, I didn't post it or mention anything about it, but it was talking about a large portion of the US population now buying Bitcoin for no other reason other than somebody they know told them to, a friend or a family member. They had no understanding or grasp on it, and the only reason that they were purchasing it was not to use it or spend it as a currency, but as a guaranteed bet on making some money and getting rich off of it. This could turn out ugly for some people. Who knows? We will see where it ends up. We will see where this ends up. But there you go. The majority of this today's topic was on metals going into 2018. And in conclusion on that, I think it's a very good buy-in price for gold. Anywhere at the level we're seeing around 12 to 1300, that 1250 range that we saw for so long. Silver, you know what? If you're getting silver at less than 17 or 17, you're doing pretty good. We could definitely see it hitting that $20 mark in a year or so, a year or two, based on what some of these big banks have said. And a lot of those numbers could change, obviously. As dynamic as the world is, as unstable as we just read about it is at times, what's going on in Europe, the U.S. foreign policy, the thing with Iran, with Korea, and then, of course, the economy, the world economy, the U.S. dollar, the Fed. We could see those numbers be much higher. And you know my personal feelings on that, what the true valuations of metals should be, and what the ultimate future of the dollar is. None of those banks are going to actually come out and say it, most likely, but I'm sure there's people that work there that share some of our common ground. And I see it in the comments. You know, I've gotten contact and emails and such from certain people that work in certain positions, and they don't say what they truly believe in their professional setting because it would be career suicide. However, they are working in those career fields, and they do know and do believe that the days of the US dollar are numbered. And I appreciate each and every one of you. Thanks for being part of the Junius Maltby channel. Hope you find this useful, this information that we put out, and I hope that you guys enjoy the most boring channel on YouTube.